today's lecture, we are going to talk about the most important financial institution in the United States. This institution is entrusted to maintain and protect the wealth of the United States. This institution is in charge of guarding the value of the US dollar. This institution has strong regulatory control over commercial banks and other financial firms. Every developed nation in the world has one of these institutions. So what is this powerful institution? The first answer that will come to mind to many when we talk about the wealth of the United States is Fort Knox, the U.S. gold repository. But Fort Knox, while formidable in appearance, is nowhere near as important as the institution about which I will speak today. In fact, the role of Fort Knox today is like the role of our Strategic Petroleum Reserve. I think I've mentioned that before. It's a secure storehouse of a valuable resource. It's nothing more. The institution I have in mind appears far less formidable than Fort Knox, but it is far more important to our national wealth. It is far more important to our national welfare. It is far more powerful, and it is far more essential to our financial system. The institution I have in mind is the Federal Reserve. The building that might be considered the home of the Federal Reserve, although the Fed, as we call it, has many branches and many buildings, is the Martin Building in Washington, D.C., which houses the offices of the Board of Governors of the Federal Reserve. The Board of Governors comprises the individuals who control the United States Federal Reserve, the central bank of the United States. In today's lecture, I will look at central banks and explain why they are the most important financial institutions in the world. Ironically, central banks do not offer banking services to private citizens like you or like me, or like the business where you work. Instead, they provide banking services to commercial banks, and that's why the Federal Reserve is sometimes referred to as the banker's bank. And, as I mentioned, they also enforce some of the laws that regulate commercial banks and other financial firms. But the real source of the power of the U.S. Federal Reserve and of central banks throughout the world is that they are entrusted with the ability to control an economy's interest rates. And they are entrusted with the responsibility to fight inflation and recessions. While the U.S. Federal Reserve is widely considered to be the most powerful among the central banks, in part because people all over the world hold dollars as part of their financial strategies, other central banks are also very important. The Bank of England was founded in 1694 to act as the government's banker and debt manager. It is the oldest central bank that we will consider in this lecture series. The Central Bank of Sweden, founded in 1668, is generally considered to be the oldest. Also of great importance is a very young central bank, the European Central Bank. The European Central Bank was created by the Treaty of Amsterdam, oversee monetary policy in the euro area. Leaders of the European Economic Community reached agreement on a currency union in which union member nations would adopt a common currency, and they reached the agreement with the Maastricht Treaty in February of 1992. The euro, as you may remember, was launched in 1999 and euro paper currency and coins began to circulate in 2002. The European Central Bank is located in Frankfurt, Germany, and the sculpture pictured in front of the European Central Bank is the actual logo of the euro. Finally, let's take a brief look at a central bank that is increasingly important in the 21st century and will be even more important as time passes. The picture is of the People's Bank of China and the building that houses that bank in Beijing, about which we will learn much more in future lectures. Let me offer you a brief history of the United States Federal Reserve. It was front-page news when President Woodrow Wilson signed the Federal Reserve Act in December of 1913. The act stated that its intent was, and I quote, to provide for the establishment of the Federal Reserve banks, to furnish an elastic currency, to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. Let me unpack that statement for you for a moment. What the enactors of the Federal Reserve meant, of the Federal Reserve Act meant, by an elastic currency was that the Federal Reserve would have the tools necessary to expand the money supply and contract it, to make the currency stretch, if you like, and snap back. That was considered to be very, very important as part of the strategy of allowing the Federal Reserve Bank to not only facilitate growth in the United States, but also to be a bulwark against banking panics. And what the act meant about when it said the rediscounting of commercial paper, it simply meant that the Federal Reserve Act allowed the Federal Reserve to accept from banks loans that they had made to private companies in exchange for currency. This would be very, very important when a rush would occur on commercial banks and they did not have sufficient cash to be able to meet the demand for their depositors. Enter the Fed, which could exchange some of their loans for cash. Now, as we certainly recall from the first and second lectures, the United States had tried before to create a Federal Reserve Bank. It chartered the first Bank of the United States in 1791 and the second Bank of the United States in 1860. But we also know that both banks were given initial charters only of 20 years and that neither bank saw its charter renewed. The Federal Reserve Act has been amended many times since its initial enactment in December of 1913. I'm only going to hit a few highlights. In the 1930s, the Federal Reserve Act was amended to create the Federal Open Market Committee, which was empowered to conduct monetary policy. That committee is called the Open Market Committee because it oversees purchases by the Fed and sales by the Fed of government bonds in the open market. So in point of fact, it is the Federal Open Market Committee that decides on purchases of Treasury bonds and sale of Treasury bonds. And it follows that it is the Federal Open Market Committee that decides on interest rate targets for the Federal Reserve and decides on strategies to hit those targets. Announcements by the Federal Reserve Open Market Committee are closely watched by financial analysts. It's big news.